session, we're going to be looking at bookkeeping transactions, and we're going to be looking at processing supplier transactions. In particular, we're going to have a little look at the supplier statement of account, and then we're going to move on for the second half of the session to bookkeeping controls, in which we're going to have a look at preparing journals. We're going to have a look at what happens when a trader ceases trading, so irrecoverable debts, how we write it off in the accounts, and also how we record opening balances. Okay. So first of all, bookkeeping transactions, so processing supplier transactions. So in this task, so this is the type of question that you may get within task 3 of the bookkeeping transactions assessment. So it is important for this task to understand the records and documentation that you will need and take into account information such as payment terms when preparing to pay your suppliers. So in this task, you might have to identify when outstanding invoices need to be paid according to the credit terms with that particular supplier. So it could be that you need to pay a supplier at the end of the month following the month of invoice. So it could be to pay a supplier at the end of the month following the month of invoice. So any invoices that you receive in January would need to be settled on the last day of February. And just remember, with this kind of task as well, any invoices would need to be added on, and then if there's any credit notes for any goods in which we've returned to our credit suppliers, we would need to deduct them. Another typical requirement is to compare a supplier statement to the invoices and credit notes that we have received in order to ensure that the statement is correct. And it's likely that there'll be some kind of discrepancies that we need to identify. And also as well, you might need to calculate prompt payment discount. So just ensure that you're okay with calculating the settlement discount or prompt payment discount. Okay, so this is a summary of Cloud Limited's account in Sky Limited's purchase ledger. Remember, purchase ledger is a subsidiary ledger and it contains a list of all our individual credit suppliers. So Cloud Limited is one of our credit suppliers. Cloud Limited has agreed to allow Sky Limited to make payments by the last day of the second month following the month of invoice. So here it's important to take note of the payment terms. So payments by the last day of the second month following the month of invoice. And then, as you can see, we've got details of the transactions within Cloud Limited's account. So we've got some invoices and credit notes here. And just remember, invoices are for goods in which we've purchased, and then credit notes are for goods in which we've returned to the supplier. And then Sky Limited has received a statement of account below from Cloud Limited. So Cloud Limited has sent us this statement of account showing items in which we have purchased and also items in which we have returned. And part A, it says show what 2 items are missing from the statement of account by selecting from the following list. So what we need to do is we need to compare the statement of account and the details in which we have in our purchase ledger for this particular supplier. So we do this by matching. So first of all, we've got invoice number 23938 for goods costing £1,250. So if we go up we can see that this invoice is actually in both, in the statement of accounts and in our details. Yeah, thanks, Fatima. Okay, so the next one. So we have goods. Let's do it the other way around, actually. So next we have an invoice for 23989 for goods costing £2,300. So are these goods, or is this invoice shown on the statement? No. Yeah, good, Bradley. Yeah, good, Fatima. So let me just remind myself which one that was. 23989. So this invoice we know is missing from the statement of account. Okay. Okay, next we have invoice 24016 for £1,460. So can you see if that's on the statement? Yeah. Yeah, we've got it here. And then we've got credit note. Let's do it the other way around again, sorry. So this one's here. So credit note, sorry, 392 for £950. Yeah, this one's here, good. Next we have another invoice for goods for 1,020. Yeah, and this one is also here. And then we have invoice 24207 for £2,540. Yeah, and that one is also there. So these ones are all included. We have matched these off. So the last one, however, it wasn't shown on the statement of account. So credit note C401 for £560. Okay, so part B, using the information in A, complete the table by firstly inserting the total of transactions with Cloud Limited in each of the months, March, April and May. And then secondly, showing the dates by which the payments should be made to Cloud Limited. So remember the terms of payment. So payments need to be made by the last day of the second month following the month of invoice. So first of all, we're looking at what is the total of the transactions for the month of March. Okay, that's right, Fatima. So how did you get the £3,550? Good, Elizabeth. Yeah. Yeah, good. Yeah, so here we're looking at the two transactions for March. So it's a £1,250 plus the 2,300. Yeah. Good. Yeah, so it'll be end of May for the payment. Good. So payments need to be made by the last day of May. Okay, so next, transactions in April. So what transactions, what's the total amount for April? Is that right, Fatima? I think you just miscalculated. Yeah, so it will be, remember there's a credit note, so it's for all the transactions within April. So you've got an invoice of 1,460 plus an invoice for 1,020, and then we need to deduct the £950 credit note. So it should be 1,530. Yeah, for the end of June. So the 30th of June, good. And then lastly, we've got all the transactions due in May. So here we're looking at the transactions due in May. So what would the total amount due be here? Good. Yeah, 1,980. So we've just got an invoice for 2,540 minus the credit note of £560. Good. Fatima, remember the missing items were items that were missing here in the statement of account, but all the items were included within our ledger in the purchase ledger. Yes, it'd be end of July. So 31st of July. And the amount was the 1,980. Okay, and for part C, Sky Limited purchases goods from another VAT registered supplier with a list price of £275 excluding VAT. A trade discount of 10% is given with a further 2% discount if the invoice is paid within 14 days. Sky Limited has a policy of taking up any prompt payment discounts if offered. So how much will Sky Limited pay the supplier? So if you want, you can have a go at calculating it and then we'll go through it together. Nearly. Anyone else got a figure? Oh, okay, you're doing it step by step. Okay, so first of all, so remember trade discount, yeah, that's it. That's right. So trade discount is a definite discount. Trade discount, bulk discount is trade discount or bulk discount can always be deducted from the net value of the goods. Yeah, so it would be the net of £275 because we're told it's the list price excluding VAT. So the £275 is our net value. So first of all, we would minus, yeah, good. So we would minus the 10% trade discount. And then because they have a policy of taking up any prompt payment discount that's offered, we need to also deduct the 2%. So we would then minus the 2% prompt payment discount or settlement discount. And that would give us a value of £242.55. So that is a new net value. And then on top of that, we need to add 20% VAT. So the gross amount payable, you're right. Oops. Pressed is £291.06. Okay, is everyone okay with calculating that before we move on? Yeah. Yeah, okay. Okay, so now we're going to move on to bookkeeping controls. So this again is looking at task 3 within the bookkeeping controls assessment, and this will deal with preparing journals, and it's likely to include irrecoverable debts or opening balances. So when a business makes a credit sale, it needs to recognise an asset for the amount owed by the customer. So remember, when we make a sale, the sales ledger control account is an asset account. So when we make a credit sale, it will be entered into the debit side of the sales ledger control account in order to increase the asset or increase the amount that the credit customer owes us, or the trade receivable. If that credit customer isn't going to pay us, maybe it's because the business has gone bankrupt, they ceased trading, we will then need to write that amount off. Otherwise, it's going to show as outstanding in our records. So to write it off, what we would need to do is credit the sales ledger control account with an irrecoverable debt. And this would reduce the asset, reduce the amount that that particular customer owes us. And remember, with double entry, we've got to have an equal debit for every credit. And just remember, the sales ledger control account is our gross figures. So the other side of the double entry, we would have the VAT, because the VAT we would be able to claim back on that irrecoverable debt. So the VAT would be a debit, and the irrecoverable debt expense account would also be a debit. Remember, if we use our dead and click, irrecoverable debt is an expense account. That expense is increasing, so it would be a debit. So our 2 debit entries would equal our 1 credit. So just remember, in the expense account, within the irrecoverable debts, it would be the net value. And it's just saying here, we would debit the sales ledger control account by the gross invoice value. So this is the amount owed by the customer. This is when we originally make the sale. Then we credit the VAT because the VAT liability will increase because we need to pay that amount over to HMRC. And we credit the sales account with the net value, the income. But then when we need to write off that account, we need to do the opposite to remove it. So we would credit the sales ledger control account, debit the VAT to reduce that liability, and then we would also debit the irrecoverable debt expense account. So we debit the irrecoverable debt expense account with a net value, debit the VAT control account, and credit the sales ledger control account with a gross value. If we want to set up the accounting records for a new business, then we need to post a journal. Now, on this particular task, it's important that you revert back to using the dead and click principles. Just remember, on the dead side, we have expenses, assets, and drawings. And if any of these are increasing, it would be a debit. If they're decreasing, it would be a credit. On the click side, we have liabilities, income, and capital. And again, this is if the amounts are increasing. So if a liability or income is increasing, it would be entered onto the credit side of the account. If it was decreasing, then we would do the opposite and debit the account. Okay, so if it's opening balances, so if it was an asset account, we would debit the account. It would fall onto the debt side. If it was a liability account, we would credit the account. If it's an expense account, such as rent, telephone, we would debit the account because it falls onto the dead side. And if it's an income account, it would fall onto the click side, so we would credit the account. Okay, so a credit customer, Barmy Budgies Limited, has ceased trading, owing Dippy Dogs Limited the amount outstanding shown in the sales ledger below. So here we have a sales ledger account for Barmy Budgies Limited. And then part A says to record the journal entries needed in the general ledger to write off this debt, including the net amount and the VAT. So first of all, we need to find out what is the amount outstanding. So first of all, we're going to balance off this account. So what would we enter, or what would we do first to balance off this account? The totals, yes, Bradley. So what would the total amount be? Yeah, so Elizabeth, I think you're looking at the carried down. So just the totals that are entered. Yeah, so you're right, it's 1,470. Remember, this is entered onto both sides of the account. So remember, step one, when you balance off account, the side, either the debit side or the credit side that has the highest total will be the total on both sides of the accounts. Yeah, and then what would we do? Yeah, the balance carried down. So where would we put the balance carried down? On the credit side, yes, on the lower side. And remember that balance carried down would then be the balance brought down at the start of the next financial period. So we know that this customer, Buy Me Budgies, owe us £624, and we need to write this off. So what would be the accounts needed in order to write this amount off? Yeah, good. Yeah, so we would have, yeah, the sales ledger control account, the VAT, and the irrecoverable debts. Good. So starting off with the sales ledger control account, what amount would we put in? Yeah, good, Fatima. Good, nearly, Bradley. So it is £624. Remember, the sales ledger control account is an asset account. So when a credit customer purchases goods from us, it increases the asset, or it increases the amount that they owe us. So it would be entered onto the debit side originally. But then because they're not going to pay that amount and we need to write it off, in order to reduce the asset, we need to credit the account. Okay. Yeah, so what is the VAT amount? I have seen that a couple of you have put it in actually. Yeah, £104. Are you all okay with getting to the £104? So you know that if we have the gross amount, so the £624 is the gross figure. If we do that divided by 6, that'll give us the VAT amount. Yeah, and it would be a debit, because remember, the VAT account is a liability, which falls onto the click side, the credit side, if the liability is increasing. But here, because it's an irrecoverable debt, we're not getting any money from that credit customer. So we don't need to pay that amount over to HMRC. So it would be a debit to reclaim it back. And then, yeah, the net 520 would be a debit. Yeah, because we were originally we expected it to be revenue. Yeah, so remember, in the expense account, irrecoverable debt, it's an expense, it's increased, so it's a debit. Okay, so part B, record the journal entries needed in the general ledger of Puppy Limited to deal with the opening entries. So when it comes to the opening entries, remember, we just need to refer to our dead and click. So first of all, let me know what type of account it is, and then whether it's a debit or credit. When I'm saying what type of account it is it an asset, is it an expense, is it an income, or is it a liability? Yeah, so the first one, petty cash. Yeah, it is an asset. Yeah, and you were right to say it is a current asset. Yeah, so would that be a debit or a credit? A debit, yeah, because it falls onto our dead side. What about cash at bank? Yeah, it's also an asset, so it would be a debit. Good. Okay, what about capital? Yeah, so capital falls into our click just at the bottom, so it is a credit. Okay, what about machinery? Yeah, good, it's an asset. And yes, Fatima, you're right, it's a fixed asset. So debit or credit? I can see most of you have put a debit. What about rent? Yeah, so rent, it's an expense, falls onto the debt side, so it's a debit. What about bank loan? Yeah, liability, credit. Miscellaneous expenses, yeah, so it's an expense, debit. Motor vehicle, yeah, good, it's an asset. Yeah, it's a debit, good. Wages expense, it's an expense, debit. Yeah, and lastly, telephone expense. Again, it's an expense, debit. Yeah, brilliant, well done. Okay. Okay, so the session has been recorded, so you will be able to receive a copy of that recording within about 24 hours. So sometime tomorrow it will be sent to you. If you do have any questions, you should see displayed on the screen the email address in which to contact. I will stay online for a while after, so if any of you have any questions, feel free to ask me. But thank you very much and have a lovely evening.